Highly educated professionals, engineers, research scientists, and quantitative analysts routinely destroy their own capital in the financial markets. The analytical rigor that guarantees success in a surgical theater becomes active sabotage on a volatile trading floor. The data is decisive. In the derivative segment, 91% of individual retail operators incur net losses every year, transferring billions directly to institutional liquidity providers. This mass failure is a biological hardware malfunction. The human brain evolved over millions of years to survive linear, physical predators. It is entirely unequipped to process the abstract, path-dependent volatility of modern financial derivatives. This biometric overlay shows exactly what happens during a loss. When a trade moves against you, the anterior insula and the anterior cingulate cortex activate. These are the specific neurological centers responsible for processing acute physical trauma and social rejection. To your subconscious brain, closing a losing position is indistinguishable from sustaining a physical injury. A red profit and loss screen triggers an immediate survival response. Driven by the fear of realizing that pain, traditional intellect shuts down, prompting traders to hold losing positions long after the mathematical probability of success has vanished. Survival in this environment requires a complete separation of execution from biology. An operator must offload their decision-making entirely to a deterministic, mathematical framework that bypasses mammalian emotion. We establish that framework by tracking momentum. The Exponential Moving Average, or EMA, applies a mathematical weighting to recent price data, prioritizing immediate order flow over historical stagnation. Looking at this chart, the white line represents the 12-period EMA. It functions as the immediate momentum trigger, tracking the short-term directional velocity of the asset tick by tick. We anchor that against the 24-period EMA, shown here in red. This acts as the short-term baseline, smoothing out the localized noise and preventing premature reactions to minor market turbulence. The visual intersection of these two averages is the signal. When the 12 EMA crosses the 24, it mathematically confirms a localized shift in velocity. However, trading a crossover based solely on short-term velocity is a mathematical trap. Velocity provides incomplete data if it contradicts the macrostructural flow of institutional capital. To identify that institutional flow, we zoom out to the heavy structural anchors, the 100 and 200 simple moving averages. Institutional desks prioritize risk neutrality. Because they frequently manage massive options positions, their algorithms must buy or sell the underlying asset as prices shift to offset exposure, a technical requirement known as a delta rebalancing mandate. This chart maps the resulting search for liquidity. The heavy lines represent the 200 SMA. Notice the dense clusters of red dots gathered directly below it. Retail traders predictably park their stop-loss orders just beneath these major support levels, turning the SMA into a massive magnetic target for smart money. Knowing this, institutional algorithms engineer a liquidity sweep. They drive the price aggressively down through the 200 SMA, deliberately triggering those stops to absorb the forced selling and fulfill their own rebalancing requirements at a discount. The algorithms then reverse the price with extreme momentum. This displacement leaves behind a fair value gap. Breakout traders who just got stopped out are sidelined, and retail bears who thought the breakdown was real are instantly trapped. Major financial exchanges and algorithmic desks treat this sequence as a standard operating procedure. Institutional algorithms legally harvest retail capital by engineering traps precisely at the mathematical boundaries where retail operators predictably hide their risk. Retail traders compound this vulnerability by attempting to force a 1% daily yield. Imposing a rigid linear calendar quota onto a nonlinear, path-dependent derivatives market is a severe violation of financial physics. Forcing an operator to hit a daily calendar target generates gap fragility. To meet the quota, the trader must continuously sell inelastic demand for liquidity into the market, absorbing massive exponential risks just to scrape a fixed yield. This split screen illustrates the trap. On the left, sideways market action causes the 12 and 24 EMAs to flatten horizontally into visual noise. On the right, the portfolio bleeds value continuously due to theta decay, the mathematical erosion of an option's time value. The pressure of a daily quota forces the operator into these exact suboptimal setups. They execute trades in horizontal whipsaw zones, ensuring that aggressive theta decay hollows out their capital base. When the market inevitably fails to provide the required daily yield, the brain's hypothalamic pituitary adrenal axis activates. The nervous system interprets the missed target as a failure to secure resources for basic survival. This triggers a saturation of cortisol that physically suppresses the prefrontal cortex, the region responsible for logical rule adherence. With logic offline, the amygdala takes control, initiating desperate revenge trading to chemically numb the pain of uncertainty. Arbitrary financial quotas mathematically guarantee portfolio destruction. They deliberately invoke an endocrine cascade that the human brain cannot overcome by willpower alone. Under this biological pressure, the trader produces a Satyam profit. Desperate to hit the quota, the operator ignores their system rules entirely, forcing execution on marginal setups just to manufacture a winning day. This behaves exactly like corporate accounting fraud. Highly leveraged, fictitious gains are logged into the mental ledger, masking a fragile, rotting behavioral balance sheet. The desperate operator records these rule-breaking anomalies as evidence of personal skill. They attribute a lucky, desperate gamble to strategic brilliance, ignoring the complete structural decay of their discipline. Sustaining this illusion requires massive cellular energy. The mind locks into a continuous state of high-frequency hyperarousal, leading directly to cognitive fatigue and hyper-beta brain rot. A profit earned by breaking the rules is merely a high-interest loan from the market. It will be collected in full during the inevitable psychological blowout. To safely extract capital from sovereign liquidity flows, the operator must align multiple timeframes flawlessly, rejecting the chaos of the amygdala entirely. This charting terminal displays the correct execution criteria under the 8I system. Price successfully rejects off the 200 SMA floor. Simultaneously, the 12 EMA crosses the 24 EMA with a steep upward slope, validated by expanding momentum on the MACD. This specific visual footprint proves directional momentum is aligned with the macro structure. It confirms the active entry of institutional capital. The system's primary defense activates the moment price action stagnates. When the 12 and 24 period averages lose their slope and go horizontal, the system mathematically declares a mandatory no-trade zone. This high-contrast visual stop signal operates directly through the optic nerve. Because the brain processes visual contrast faster than emotional complexity, the flat line acts as a physiological circuit breaker, actively revoking the operator's permission to execute. Execution is then filtered through the 8th Kelly protocol. By aggressively capping risk to roughly 1.9% of capital per trade, the system absorbs the probability of mathematical ruin, preventing the onset of financial panic. The 8I framework operates as a cold algorithmic board of directors. It strips away retail noise and permanently substitutes the trader's chaotic internal biology for unbreakable mathematical law. The market is indifferent. It does not respect human effort, intelligence, or arbitrary calendar schedules. Disciplined execution requires a quiet, clinical audit of the present order flow. Implementing the rule, one trade a day keeps losses away, removes the cognitive exhaustion of overtrading. It preserves your limited executive fuel entirely for high-probability, structurally confirmed setups. You must offload your survival to a deterministic framework. An algorithm does not suffer from cortisol saturation, and mathematics cannot experience cognitive fatigue. Through this rigid discipline, the chaotic, fear-driven gambler is permanently overwritten by the executive logic of the operator. Process kills emotion. Rules build systems. To survive, you must subordinate your flawed mammalian biology to the math.